What a week it has been. This is our last session ahead of the Eid break, the Eid al-Adha break. So happy holidays to all of those who are celebrating Eid. That's the whole of the Middle East will be shut down over the next week or so. But nonetheless, we go into the Eid holiday with a really dramatic backdrop. Oil prices have, I hate to use the word collapse because it's still $100 a barrel, but nonetheless, a serious decline. There's so many forces in play, it seems. Let's go to Dr. Carol Nachley, CEO, Crystal Energy. I was going to say our every Thursday morning quarterback, but I'm going to have to say our every second Thursday morning quarterback. Dr. Carol, your thoughts on where the market's at this morning?
Good morning, Sean. Good morning, everyone. If you thought the markets are going crazy, I would like to see what's going on with British politics.
I don't know if it's me, but I'm finding Carol sound very bad. Is it me?
Yeah.
Or
Can you hear me now?
yes. Yeah.
Okay, great. So I said, good morning to you and good morning to everyone. And if you thought that the markets are going crazy, wait to see what's going on here in British politics. So they are keeping us on our toes with all the excitements and the scandals going on. But look, what we're seeing today is, I'm not quite sure whether it's driven by market fundamentals because we don't know really yet. We haven't seen signs of demand destruction, at least strong evidence to support that. There's this main fear today of a recession, and that by itself is driving prices down. It's not only oil prices that went down. As you look at the trend, it's all major commodities, if you want, like copper, for example, is also going downwards because of this fear of recession. Does this mean that it is going to happen? I really don't know. It's a bit uncertain at this stage because, as I said, we don't see additional supplies on many fronts, easing up, coming up to the market. Demand destruction usually takes time for us to get the evidence. But again, as you said, Sean, even though we saw a decline compared to, for example, a few weeks ago or a few months ago, it's still quite high compared to, for example, a year or two ago.
Let's go to Sydney in Australia with Peter Maguire, CEO of XM Australia. Peter, there's probably many factors in the financial markets to point towards. It seems to me one of the big ones is again the soaring dollar, or perhaps the other way to look at it is the declining sterling and euro, and yen is already well below par. All of that putting a greater weight on the burden of energy prices.
Absolutely, Sean, and good morning to everyone. 106.87, Sean, I'm just seeing a read now. We're nearly at 107. Who could have imagined it as far as the ballistic move to the upside for that US dollar index? If I'm looking at the pound of 119 and what Carol's saying, many analysts I'm talking to are saying a 113, 115 over this summer period. So, wow, there's going to see further downside for the pound with uncertainty there with Johnson and his troop. And the other side, which is one of much interest, and I'm looking here at 102.10 for euro. We weren't that long ago, Sean, and it was 122. So, we've just seen a capitulation. The yen hasn't moved. All the smart money's dumped euro. The yen's taking a break after a 19% washout over 6 months. So it's having a little bit of a holiday, and all the smart money moved to US dollar long, naturally euro short. Energy prices, I noticed $11 stripped out yesterday or Tuesday in the States. Tuesday trade, so that really is catastrophic, and the Brent market was collapsed down. So yeah, we've got Brent now at 100. I think there's structural weakness as far as recessionary fears, and everyone's worried. I'm interested to see non-farm payrolls tomorrow night, Sean, how that looks, and if it's softer than what we expect and those recessionary fears, then yeah, maybe we're going to see a further downside for crude this week.
Let's go to Walter Simpson, Managing Director of CC Energy Development in Oman. Walter, the correction in oil prices inevitably is bringing it perhaps to maybe a more sustainable level from the perspective of producers, but nonetheless, you're trading, you're selling your oil already post-summer now. The contracts are trading and delivery. So you're already locking in above $100 for the year. Where do you see things going, and what is, in your thoughts, driving prices to the downside of the range where they've been in?
Well, good morning, everybody. Sean, thank you. I don't think my opinion's any different from both Peter and Carol. Look, it's fears of recession. It's not really the demand side at present. I mean, there are tightness in supply, which you'd think would drive prices the other way, but it's the fears of the recession that seem to be taking the precedent at the moment. Turmoil in Europe, turmoil in the UK, none of that seems to be impacting it at present. It's more to do with, we think, recession's coming along. I'm not overly concerned at present, to be honest with you. I don't think any oil companies basing its business on $100 oil, that's for sure. The prices are still on the upside for us, and I'd be perfectly happy in the $80 to $100 range. No issues there whatsoever. And I think it is a more sustainable price. I think 120 was a bit on the high side. So reasonably comfortable where it is at present, but I am concerned that the fears may drive the price further lower and lower rather than the realities.
Yeah, we've had Citibank, of course, call 60, 65 by the end of the year. They're kind of an outlier, but nonetheless. Carol, are we seeing, in essence, the end of the Ukrainian premium, Russia's war in Ukraine premium, which pushed the price up from that range that Walter references, 80, 90, up to 120, and now we're giving that up because ultimately demand destruction outlook will possibly be greater than any disruption of supply from Russia?
Well, there's definitely, the thing with wars is that the longer they take to be resolved, the more the people get tired of putting them as their priority. So there is some kind, maybe today, kind of, after the shock has passed, there is some kind of, I wouldn't say fatigue, because it shouldn't be fatigue, but that's the nature of human beings today. So many news coming every day on a daily basis. And it seems that with Ukraine, it's not getting any worse, not getting any better, at least in the headline news. And it seems to be the situation is going to drag much longer as it is for the time being. And therefore, the shock, the premium that was associated with that shock when the war started and all the scenarios, the worst case scenarios that were introduced. I mean, if you look, for example, at the IEA's monthly oil market report, if you look at their publication from March, April and May, you can see that each month they kind of revised downwards the kind of how much oil would be lost from the market because of the war. So at the beginning, they said there will be a major supply shock, 3 million barrels a day to be lost overnight, very quickly. Then they said they changed the tone to 3 or 1.5 million barrels a day and 3 million by May. In May, they said, maybe roughly 1 million and then 3 million by the end of the year. Because people realize that with oil markets, it's global by nature, and oil is fluid, is liquid. So it's still going elsewhere. Even if it's not coming because of self-sanctioning to some markets, it's being diverted elsewhere. So that kind of is the fear. However, we have to be careful that we don't know that maybe tomorrow what Mr. Putin can do, for example, and that can set the market in the opposite direction. You also have to remember that we're heading towards the winter season, although we're also thinking about the summer season, but winter, what will happen, for example, with gas markets, with repercussion also on oil markets and the premium perception. So we're still in the uncertain territory, but at the moment it seems that yes, the premium on Ukraine has been deflated to a certain extent, but has not dissipated entirely.
Peter, I suppose also that's maybe weighing down on the expectation for demand outlook is China isn't really showing the muscular recovery from the first half of the year that we have, that some were expecting big stimulus and going into cheese coronation for president for life, that it was going to be money for everybody. That doesn't seem to have really transpired.
Exactly right. No, exactly right, Sean. And I'm just reading commentary as far as certain cities are, looking at further lockdowns or reintroducing. So that's not a good sign. And I was talking before the show started with Walter, as far as how the world seems to be opening up, but there are many parts of the world that aren't opening up as quickly as others. And so this is the great issue from a demand side. China is a little bit of a laggard at the moment, and they're certainly far from being the knight in shining armor to save the world or save, from a demand side and to get everyone producing more. I don't think China's showing any green lights or green shoots at the moment that are that favourable. And we've got to look at other markets. That's where, the iron ore collapse, copper collapse, a lot of the base metals have really hemorrhaged, and maybe they moved quicker and oil sat on its hands, but now even that's starting to have quite a large retracement.
Peter, just to come back and get your thoughts on the earlier point of what it means for China, this bionic dollar. Obviously, the Chinese manage their currency in a very tight band, but what does this big dollar move, how does it impact China, do you think?
Well, it's 20 years since we've been at this sort of number, Sean, 107. We did hit a 120 in 9/11, so that's just over 20 years ago. So this is really uncharted territory in a lot of ways. Over that duration, we've had, you know, a dollar that's been much softer, and now with a very strong dollar, it's going to have, I no doubt believe, some reverberations felt internally in China, and I'm curious to see how that all plays out over the next 6 to 8 weeks, because we all understand the strength of that dollar and the impact it's having to many Asian economies. And I think it's going to be a fairly hard grind out for the likes of China and a number of those Asian counterparts.
Walter, I wanted to get your update more or less on where, I mean, as you said, most oil companies are budgeting at much lower than these high levels that we've seen, but nonetheless, the opportunity to increase capacity, obviously that's slower than maybe many would have expected. What's your outlook for that, Walter, in the second half of the year with oil prices and the uncertain economic outlook in terms of oil production, new oil production capacity coming on stream?
So the project cycle for bringing new production is much longer than the oil price fluctuation. So people will have made their decisions. And they're either acting on those and moving towards putting that extra production capacity in place right now, in which case it will come on, or they haven't made the decision yet and they'll still be hedging on it and decided whether to move forward or not. They may take a bit longer to make those decisions. But I think certainly in the short term, the majority of those people have made their decisions and they're moving forward on those projects to get things going. As I said, most of us will have budgeted at much lower prices than we're currently seeing. And so any decisions that have been made at those lower prices. So I think things will continue at present. Certainly there's concerns about what might happen, and people will have contingency plans about what happens if the oil price drops way below 80. But I don't expect it to have an impact on those new projects just yet.
What about I mean, we always talk about shale and where, I mean, of the many big producers, Russia, US, OPEC in general, that US seems to be the laggard, and in some ways the shale opportunity is a manufacturing format in the sense that it is the one area of oil production that can come back pretty quickly in terms of the technical approach to drilling or production of shale oil, and they're still about 1 million barrels below their pre-COVID level. What's your thoughts on that return in the coming 6-12 months?
Again, a much shorter term project cycle for those shale wells. So I suspect they will be much more dependent on oil price and be looking at it. Current levels, I think the oil price is good for them. But if they're seeing or predicting an oil price dropping towards the back end of the year and getting back to the $80 a barrel level, then they may think twice about those investments. So I suspect there's going to be more challenges to that shale oil for the US as we look at these prices.
Yeah, it seems to me, I saw headlines during the week that, as we've talked before, the supply chain limits that they can't get the sand that they need in order to frack the shale wells. There's a shortage of the appropriate sand that they need for that technical requirement. Carol, let's look a little bit at the developments overnight in the US. I mean, Iran, US, we're not seeing the US impose secondary sanctions on those who are still buying Russian oil, and there's now 2 million barrels a day of Russian oil going to China. But we saw overnight more a sort of tightening of sanctions on Iran and those violating the sanctions there. They referenced the Emirati companies, Chinese companies, and looking to put a bit of a vice grip around what had seemed to be a kind of a lax supervision of Iranian oil flows.
Sean, if I may, before I answer your question,
Yeah.
just to go back to the important issue of investment that Walter was discussing, because it's not just the oil price, but also cost inflation that we have to factor in. And I think you mentioned that, for example, not being, you don't have enough sand for fracking, but it's overall cost inflation, which mirrors, follows, trails oil prices. And also there is government policy, because I was thinking here in the UK, for instance, the government says, I want to encourage more companies to invest in the North Sea, and yet they go and they impose the highest tax rate that we saw since 1993 on new oil and gas development. So that's one thing to take into consideration. It's not just the oil price that dictates investment, but we have to think about cost inflation and government policy. With respect to the US and Iran, well, this kind of gives some clarity to market observers that Iranian oil is unlikely to come to the market, because actually, the longer these negotiations were taking place, the less hopeful we were in terms of reaching an amicable solution between the US and Iran. And if there was not going to be any solution, I don't think the US was going to turn a blind eye. On the contrary, they were going to toughen their stance on Iran. I think this is what we are seeing today. So in that respect, the market did not factor in, I would say, the return of Iranian oil to the market. It can help, of course, in easing price pressure. But if it's not there, then you just keep it, on the side, and then you continue with your analysis of the market. But yeah, so I am not factoring in any return of Iranian oil barrels to the market anytime soon. But that by itself is not needed at the moment if the market continues showing this kind of signal to market investors and prices are going down. So Iran is not as important to current oil market discussions as it was, for example, maybe towards the end of last year, at the beginning of this year.
Peter, just picking up on those kind of recessionary concerns on oil price, the idea that the oil price decline, obviously it was sitting above 120 and around 120 for a period. It's now obviously down around 100. I'm wondering how much of the work for the Fed is being done by the lower oil price, and where the financial markets might assess that the Fed and others may pull back from the bionic sort of tightening that was foreseen. What do you see those two things impacting each other going forward?
Well, I think the first sign, Sean, is going to be tomorrow night and what we experience as far as that non-farm payroll. The second one, of course, is as the Fed have taken a front load aggressive stance, and many other central bankers across the world have, the issue quite simply is that you're now seeing third quarter 23 as a rate reduction cycle being commencing. This is only a year away, and that's what the forecast is. So there are many central banks are now saying that they'll be going in the second half of 23 loosening rates. So this is the dilemma that we're facing: stagflationary fears, recessionary fears, which are mounting daily. That's the noise that I hear across all the analysts that I talk to across the globe. Everyone's saying they're definitely worried about out of control inflation, recession, and economic growth leading forward. So I think it's going to be a tough ask, and I'm not sure how aggressive Powell's going to be come August or September. We've just got to wait and see where crude is, and if it's sitting at $80 a barrel, it's going to be a very big, slap on the back for him. It's going to help him tremendously.
The Fed minutes yesterday did indicate that the sort of aggressive tightening remains the priority, and given the challenge that inflation is, and the need in essence also to get interest rates up a few points so that you have somewhere to pull back from if you need to, which definitely seems to be on the cards. Walter, your thoughts? Obviously, sadly, yesterday the Secretary General of the OPEC passed away, and our condolences, as expressed yesterday, and express again to Secretary General Barkindo and his family and all at OPEC. But the big change at OPEC, Walter, coming, His Excellency Barkindo was in his last month in the post, You in Oman have now recently also had a new energy minister appointed since we've had you on last. So see big changes from the point of view of managing the regulatory oversight of all of this oil supply policy. And I just wanted to get your thoughts on the outlook for the OPEC plus agreement, which expires in the coming months, and all this new leadership coming into the management of that. Your thoughts?
Interesting. Look, the change in leadership comes at a difficult time for them, and despite the tragic death, the change was going to happen anyway, and it was going to happen just before they need to revisit their agreement. My view, I don't think it's going to be renewed. I think it's served its course, and I think the global political status with the Ukraine war, etc., means I just think it's going to be too difficult for it to be renewed. I think OPEC as it is flat out on production. I don't think there's any more capacity to be had significant. So I think that again brings it back to why bother renewing it. And internally in Oman, no real surprise. The minister was going. We knew that. The replacement, Al-Ofi, fully expected. There was a very short list of candidates who could take on the role. He was sitting at the top of the list, so no surprise there. I think the only surprise that maybe certainly caught me by surprise was the timing. It was a little bit quicker than had expected. But I think that was driven by what His Excellency His Majesty wanting to make a number of changes all at the same time. So again, very familiar with the markets, very familiar with the OPEC plus status. So I don't see any dramatic change in the relationship Oman is going to have with the OPEC countries and with the GCC countries around the oil industry. So I think more of the same. It is going to be challenging for them with the changes, but I think we'll see the agreement disappear. It won't be renewed, and people will go flat out to try and meet demand.
Flat out to meet demand.
Sean, can I add just
Please.
very quickly
Yes,
on that?
Yep.
I can see the point that OPEC Plus is maybe producing at maximum capacity, which I don't think so, because there's still some capacity within Saudi Arabia and the UAE at least. But also have to think about OPEC Plus. Its importance is more than when prices collapse. So you want to have this kind of group of very powerful producers to be able to save prices from going down, to the red zone area that is painful for all these members. So we should see beyond, just what's going to happen in the next few months and prepare for the worst case scenario. So for me, OPEC Plus is more about the longevity of an influential producers group for the longer term, and not only just what is happening today.
Yeah. Well, I suppose the challenge to get through the gateway of revisiting quotas is always a very difficult conversation, and unless there's some really burning need to have that fight, it seems that that might be a difficult one. Why would you have it when you don't have to have it? But let's see where that goes. Let's go to the survey question for the day, which is really sort of picking up on the points we were discussing earlier. Demand destruction from inflation and slowing economies will be greater than any disruption of Russian oil supply in the second half of the year. Because that seems to be what's dawning on the market here after a few months of IEA scaring everybody of 3 million barrels a day destruction and everything like that, prices shot to the moon, and now it's sort of dawning on everybody. Well, actually, the oil disruption from Russia will not be that great. Demand destruction could actually be greater. So that's kind of the thesis there. Your vote on demand destruction from inflation and slowing economies will be greater than any disruption of Russian oil supply in the second half. Then we'll get our panelists' views on this 10 days in which we are going to be absent from the airwaves. What's the tea leaves going to tell everybody in that moment? So perhaps, Carol, we'll kick off with you on that. You started your conversation this morning with Boris Johnson. Let me let you finish it. Will Boris Johnson be still in the hot seat when we come back Sunday week, and any other developments that you see to watch out for over the Eid break?
It's amazing what this guy has gone through and how his popularity is perhaps he's the most unpopular, perhaps Tory MP these days, or Tory politicians these days, but still he managed to survive. So despite all what you're hearing, he may well survive, but not for too long. So that's the short-term view versus the long-term view. And on the broader picture, lots of economic data coming in, some interesting meetings I can see from the chat room. I thank you guys for keeping up to date, are happening this week, and that would be interesting to see if there are any new announcements from some politicians around the world vis-a-vis Russia, for instance. So we're living in a very uncertain time, and of course, market volatility will continue to be with us. So when I see you, hopefully in a few weeks' time, we'll be talking about, maybe prices going up again. Let's see.
Just on that point, do you think the steam, just to put you a little bit more on the spot, as I will the other two, that the oil price decline that has run its course, or is there more downside, do you think?
If we have more data supporting demand destruction, then I can see a more pressure on the downside. But if 1 week we have, data showing build-up of inventories, another week a reduction in inventory, I think we will continue to be in the volatile zone area. So I'll keep an eye on economic data, macroeconomic data, as well as inventories built up, particularly in major economies.
Peter, your sort of outlook for the next 10 days, and particularly when it comes to the financial markets, we're seeing the equity markets after what had been a sort of really bad first half of the year but mainly in the first half of the first half. In the last few weeks, it seems to have stabilized a bit. What are your thoughts on the outlook for the financial markets?
Well, I think it ran out of steam, Sean. Like any market, it was probably pushed down too heavily. A lot of traders then jumped on US dollar. I think over the next 10 days, I won't be surprised to see a 96 handle for Brent. I think gold will test probably 1720. US dollar index a 109. I'm going out there because it's at 107. I'll go 107.50 to 109, that sort of range. I think there's further upside. And I wouldn't be surprised to see a little bit more of a bounce to the upside for some of those US equities and global equities, because I think they've been pretty heavily sold off. So I'm just thinking maybe, 1 or 2%, but they're going to be volatile. And it's an absolute wonderful ingredient for traders.
Do you expect parity on the euro to break through parity?
I don't know whether a breakthrough, but it's at 102.10 at the moment, and I won't be surprised to be a 101 to maybe a 100 or 1.050. So I think, yes, Sean, I think further softness for naturally the US dollar a little bit further upward, onward and upward. And
Okay, let's get Walter with the last word of the survey result. The agree 65% demand destruction from inflation and slowing economies be greater than the oil disruption from Russia. Walter, your sort of thoughts on closing out ahead of the Eid holidays, where the markets may be going and what you'll be keeping an eye on?
I think Peter said it, volatility. I think everything's going to still stay with people having views depending on the latest piece of news. The political situation in the UK and in Europe, who knows? But whether the grease pig will survive or not, who knows? We'll see. There's going to be challenges there. I also think, with the markets, what happens with the inventories? I mean, there's going to be ups and downs. We're seeing Russian oil is getting to market. It's being sold. So I'm not surprised that the 65% say, look, it will be demand destruction that which will have a bigger impact. The question is whether demand destruction is real, and we don't know that. And people will have their view, and I think people will take the indicators that support their view as being the ones that they'll back. So I'm convinced we're going to have a volatile period. We'll see what happens. But if you want me to pick a number, I'll say oil prices stay pretty much the same. Actually, I think we'll go up and down, but on average, we'll probably sit around the $100 mark.
Well, let's wrap it up there. What I'll be watching over the Eid, not the most pleasant thing in the world, but the progression or lack thereof in Russia's war in Ukraine. Russia has had some very significant victories. Finally, one might say, after 4 or 5 months, from their perspective, a horror show from a Ukrainian perspective, but nonetheless, they've finally taken half of the Donbass provinces. They're going after the other, likely to take that over the coming week. And then what? The two big provinces that Russia has always had their eye on, that they've had occupation in and militias operating in for 7 years now since they took Crimea. So finally, they're going to secure them in a military way. Then where do we go from there? That moment, I think, will be a defining moment. Do we then point towards the end of the war, or do we then point towards, no, we're going for more? If it's the more piece, batten down the hatches. If it's the okay, we're done, we're satisfied with holding this, and if where that goes, I think that will be a determining moment. That could happen over the next 10 days. I would suggest keep an eye on that, because that could dictate the direction of a lot of things. Thank you so much, Walter. Carol, enjoy your weekend of entertainment from Boris Johnson. Will he or won't he? Nonetheless, it's Sky News at its best, keeping us entertained. It's unfortunate that it's entertainment, because, my goodness, we all know that Britain is facing many different challenges, and it's so important to Europe that Britain is strong, both in all of its politics and all of its economics. As such a critical country. And thank you, Peter. Have a great Eid break. Not that you're doing Eid in Australia, but nonetheless, I'm sure there are many people that are. Best wishes to everybody there. Walter and Carol, thank you so much. All the best. We'll catch you on the other side. Cheers.
Thank you very much, Sean, and Eid Mubarak.
Thank you, guys.